computer. Okay. All right, everyone, we are live. Really like to welcome Brock and Chris of Kirkland Capital Group here today, experts in real estate debt and also really combining real estate debt into a fund. So we've talked about a lot of real estate here at Rocket Dollar, but there's so many different types. We have had a few webinars recently about debt on an individual level, targeting individual property. Today it will be from both the fund perspective. We're going to have some very interesting stuff on how that matches up against stocks and bonds. So first, I'm going to let Brock and Chris go, go kind of through Kirkland Capital Group, how they work, how debt can serve as a replacement for bonds here. And then I just have a little bit at the end, general retirement education, going over some modern portfolio theory, stuff about, how much alt should be in your portfolio, stuff that you hear about constantly from different advisors, but just kind of making that a little bit less nonsense and easier to understand. So Brock and Chris, feel free to introduce yourselves and take it away here.
Great, thanks a lot. Appreciate this time to address everybody. Let me start off with a quick intro for myself and then a really quick intro about KCG. I don't want to get into too much of that. I want to kind of get into the meat of what we want to deliver today and educate about. And then I'll let Chris intro before we kind of kick it off with diving into some things that Chris and I have been talking about a lot with a portfolio theory, et cetera. So it's a great subject. First, just about Kirkland Capital Group. We specialize in micro balance, commercial and multifamily real estate bridge lending. That is loan amounts under $1 million. This is usually going to be your anywhere from a 5-unit to sometimes up to 25 units, depending on the location, apartment complex. There's a lot of these around the nation. It is a very key multifamily apartment type of complex type of housing that's available usually in Class B or Class C. There's millions of families that rely on good quality housing in here. And so we're really happy to be able to be providing the funds to see many times what has become a Class C be upgraded to a Class B and provide just really nice quality housing for people. Along with that, so our commercial real estate debt fund, the Kirkland Income Fund, provides investors with lower risk and consistent targeted 8.5% to 9.5% annual net returns, which we pay out monthly or can compound. So what we've endeavored to do is create a very low risk or a lower risk type of investment possibility, really to sit in that fixed income area. And we'll talk about that more in a minute. My background is really finance and technology, but more on the real estate side. I spent quite a few years underwriting loans, auditing loans. I also spent some time in corporate finance. And then a lot of it was also bouncing between automating much of corporate finance as well as underwriting and mortgages, et cetera, in the real estate space. Chris?
Yeah, thanks, Brock. No, my background is a little over 25 years across a variety of different investment management platforms. Started my career in traditional assets, mainly just long stocks and bonds, and then quickly found myself into the alternative space, dealing with hedge funds, venture, building companies from ground up, a lot of different private real estate plays as I was managing a number of different portfolios, and also dealing with individual clients that held a lot of complex real estate. And then led me to here where Brock actually brought this idea of, hey, we have a unique opportunity to build a fund and bring a product and a platform at a very interesting time when interest rates, thanks to COVID, are now at 150-year lows.
Great, thanks, Chris. So Chris and I have been talking a lot about the changes here, and he mentioned it there with these super low interest rates. There's been a long tradition of balancing a portfolio between the 60-40, let's just call it the traditional 60-40 equity/bond portfolio, where you'd place 60% of your investment portfolio in stocks. That could be ETFs or anything around more high growth stuff. And then 40% in more of a lower risk, fixed income. A lot of times those are bonds or bond funds, that sort of thing. And that has actually served most investors very, very well. The challenge now, though, is with these low interest rates, is that traditional 60-40 portfolio dead? That's really the question Chris and I have been tossing around. And Chris has come up with some interesting ideas about, maybe on one side it is, but maybe on the other, we just need to do some replacement. Chris?
Yeah, no, we can talk. I always think dead's a really harsh word, but it has been thrown around a lot by a lot of Wall Street of how to think about that 60-40, that Markowitz portfolio that was invented eons ago that has worked well for many, many people. One of the things that you're looking at in this particular time frame is a situation where, equities, I think a lot of Wall Street is generally seeing headwinds in the face of equities. They're pretty much all expecting still a positive return on the equity side, but and they're talking broad index based. They're not picking names per se, but they're not looking at the double-digit returns we certainly saw in the last 2 years. We'll see. We'll see if they get it right. But there's a lot more pessimism on the equity side. So, just talking about, there are two components to what we're talking about in 60-40. And if you're going to think about the equity side, some people have gone out and said, hey, you should think about private equity as you're still able to obtain some value. And the general estimates that I think people are saying is private equity should slightly outperform your public or more traditional investments in the equity side. But shifting to what we really primarily focus on is that 40%, or in some cases, as the population is getting older, they may have more than 40% in fixed income. And talk about, historically, the 40% was there for two reasons. One, it was a source of income generation for people who might need that income rolling out of their portfolio, and utilization as supplement of not having a job as they were retired. And the other aspect is that diversification, that nullifying some of the volatility that might occur in your portfolio, because the last thing you want to do is be in a very volatile portfolio, need to be able to pull out money just in the time when the market crashes. So that was that portion where a lot of people would be harvesting less volatile capital as they needed it over time, and then hopefully making readjustments and rebalancing their equity portion. Fixed income still, to some extent, depending on, when we say fixed income, that's a wide swath of all the way from 91-day T-bills all the way to your high yield corporate debt. So there's a lot of variances that I don't think we have time to dive into just on the traditional side. But the general premise is that is not going to, if you're going to try and capture yield, you're going to have to go more towards that end of the curve that's on the high yield, which historically has had the volatility similar to your equity markets. And so to meet your required returns that you might need in a portfolio, you're either going to have to take on more risk and stay in the liquid markets to capture that, or look towards the alternative investment field, which is where we're positioned. And we're just one alternative of many. There's many, many different ways to generate income. But the one that we have chosen, because we like the risk profile, is the commercial real estate debt. And that's one of those things where you should see negative correlation, which is the basis of diversification. I always have a lot of investors that I talk to. Everyone's telling them to diversify, but they don't understand what that really means. And the basis of that is correlation. So I spend a great deal of time educating people of cross asset correlation, and you want that instrument that you're going to add to your portfolio that's going to be a replacement to some of that fixed income to really still be that risk mitigator. So that's an important aspect. And then with interest rates at all-time lows, you've got to find that source to where you can capture enhanced returns, a spread above the traditional instrument. And that's usually going to require some extra due diligence. And, I think one of the major drivers that people see in the alternative space is it usually comes with the cost of a little bit of illiquidity. You might not have a market instrument. You might have to have a longer hold period, sometimes a year, sometimes a quarter. But that's definitely something that is going to be important that people need to consider going forward in your portfolio. And that's what we have definitely strived to build at Kirkland Income Fund.
I think that's what's so interesting about this sort of partnership we have with Rocket Dollar, in that it makes, obviously most of the money that's coming into Rocket Dollar is retirement funds. And so that's really aligned very well with these longer term holds, particularly on the fixed income side, whether it's our own real estate debt fund or other real estate debt funds, or even on the equity side that you might want to hold real estate stuff.
Yeah, and exactly. I mean, for a lot of clients also, scheduling that and understanding what you've got in those retirement funds to make sure you're meeting your required minimum distributions. If that's what the stage you're at in your investment life cycle, that's another factor that you can easily sort of balance out. And as you go into alternatives, understanding that liquidity is important so that you can effectively, manage that with your timelines of when you'll need to take distributions from that qualified funds.
So you mentioned about the 60-40. I mean, you're right. Probably dead is not the right word, but there's going to need to be some changes. Maybe not so much about the split, but certainly what has traditionally been put into that 40%.
Correct.
The bonds aren't going to work. Now, let's say that I'm an investor that has been holding bonds for a while, and now it's either with a bond fund, and those are a little easier to sell out at any time, or I've held some bonds and those are now up, and I go look now and try to find that yield. What happens to those bonds or that bond fund if interest rates go up and I'm holding those?
Yeah, and that's the premise of where I don't think you can't pick up an article. And if anyone's looking for an article, I've got a number from J.P. Morgan, Goldman Sachs, Morgan Stanley, all sort of the same issue. At no time in history, I think was the quote from this strategic asset allocator at Goldman Sachs, have I been able to come on and say, if you're going to go into fixed income now with new money, you're looking at either capturing low returns or locking in a negative return. And what that means is right now, interest rates are very low. So whatever you buy into at this particular time, you're going to be capturing a relatively low interest rate compared historically. And that's going to hurt your required return measures in your portfolio. But for people who are currently holding fixed income, even when you look at broad indices that were up fairly good last year, up 7% plus, that is a return that has risk within it. If interest rates do come up, and I'm not saying when and if that will occur, and I know there's lots of fears around fiscal cliffs, but when you do start to see interest rates go up, it's simple bond math. I mean, there's no way to escape. As interest rates rise, bond values will fall. So you'll see a deterioration of that either unrealized value that you have in a current fund, or or you might be going in, today and experience, a negative principal return. Obviously, if you realize it, it becomes a real return, but a real return negative. But it'll be on your book as an unrealized negative return going forward if interest rates rise in any material way.
I think the other thing you and I had talked about a bit too was really the difference between looking at some of the higher risk bonds or bond funds, such as corporate debt, or even what was called junk bonds, versus possible risk in the real estate mortgage market. Of course, we're just one fund in that. There's a lot of different real estate debt funds in there, but in general, what's your opinion about the risks between those two?
Well, yeah, I mean, corporate debt, obviously you're dealing with, sub triple B rated bonds and companies. So you do have a potential default aspect to that with not near the solidarity of what I like in the real estate side of, at least what we've put together. If we write a loan, the back end to our loan being first lien, full recourse, and we have right to an income producing property. And you're looking at a situation where if LTVs were structured correctly, you're coming in at a pretty steep discount, 25 to 30% plus discount. A lot of things, I like the risk profile of that because you're very well collateralized. And you're also looking at a situation, everyone's always worried about default turning into foreclosure. Most of the investors that we work with, and even other people that I know that run funds, there's a lot of motivation to hold on and maintain the security of that asset. If I'm the borrower, last thing I want to do is have to foreclose and walk away from it. So there's going to be a lot of effort put into secure that and ensure interest payments are made. and that and that as a borrower, they're going to ensure that is cured and moves forward for those lenders. So I like that risk profile. I don't think we're in a situation of where you're going to see mass defaults and then leading to foreclosures. You might have a few things where there's extensions to loans. I think that happens far more frequently. And that's where I really like that risk profile of having that asset supporting this loan. But yeah, and your corporate side, and obviously you go down the curve of backed by the good faith of the United States government, and you're dealing with treasuries, you can kind of see what happens to the interest rates. Well, as you're taking less risk and you're backed by the taxing power of the United States, yeah, rates plummet quite quickly. I think high yields estimated a return this year is about 4.8%, and you're looking at 10-year treasuries just over 2 is the expected return. So, I mean, it's pretty dramatic.
And a quick question just to interrupt, and Brock, your camera, the background, that did help a lot.
Yeah,
So
I'm glad that cleared that up.
Yeah, that's got Brock looking pretty. It's great high definition camera there. Want to make sure he gets full use out of it. So just Chris and Brock, as we're talking about this different risk and ratings of certain bonds, could you just tell me a little bit about the properties and risk profile that you approach at Kirkland? Because there's the A's and B's and C's and the D's, and everyone has a different A, B, and C and D, what they feel like. It's a lot of argument in those.
If you talk about the properties, yeah, let me address that. Let me mention something first before I dive into that. I've heard it said several times by several people that one of the most low risk places that you can put your money is an unlevered piece of property. Now, that's an interesting theory. The challenge with that is that that's not exactly true, because although you might not have the loan as a pressure against that property, if the value of that property drops a bit, then you're going to lose on that. We tend to think that actually even a more low risk is to do debt on a piece of property, because if you're at a low LTV, which we are, and now let me kind of go into where we're at there, we typically go up to only 75% on multifamily. We are still looking at some office and some retail. We haven't done a deal yet. We haven't seen anything we liked yet, just because of what's going on with the pandemic, and we don't think we're out of the woods there. We're looking at maybe 55-60% LTVs on those. So that gives us a lot of headroom. If something were to happen with that property, then there's a lot of room there for mistakes to be made on the borrower's standpoint or on the buyer's standpoint, and for us to go back out there and do what we need to recover that property and sell it and recover all of our principal that we have invested in that property as a loan. So we think that really puts us at a far lower risk from the principal standpoint than even holding property by itself. Your question around ABC types of properties, we've chosen to focus on this microbalance. Obviously, since we do that, really, you're not going to see any Class A properties. That's just not going to be possible to build those for that. We don't do construction loans. We focus on income producing properties, or properties where income can be produced very quickly, even if currently maybe there's problems with the property that needs to be turned around. Those are typically going to be Class C. The reason those are good is because for our typical borrower, they go in, they buy these from somebody, usually a mom and pop who's owned them for 20 or 30 years, kind of let them go. Maybe there's some deferred maintenance. Maybe they haven't had renovations in many years. And so there's a great chance to go in there and take what is a Class C property and turn it into, with some nice renovations, into a very nice Class B property. One that, look, if you and I are squeezed on income a bit, that we would end up living in and be very happy to live in. And we feel safe in that area. And we feel safe in that apartment complex, in a place that's quality. That's what we want to see. And that's sort of the plans we look at when we look at these value add deals from borrowers. We are seeing a few Class B where people are picking it up. Maybe it's been turned around and they're picking that up from somebody who has turned that property around. And now they need to season that a little bit before getting long-term financing. But honestly, we really believe and like that Class B and C. You can't build them for the cost of construction anymore. So there's no one building class B and C. So that's one reason why. And with what we're seeing across the United States in most areas, that there's still a housing crisis. There's still a lack of affordable quality housing for the middle market. And that's really what we're filling in there, is we're taking and providing with our loans and in cooperation or partnership with our borrowers who are buying these properties, producing more quality middle market housing that's needed, particularly among people like our first responders that are so important in our economy and right now. And we have a focus on that with this pandemic.
Great, thank you. All right, and Chris, so you got more there. I do have some awesome, illustrations of some of the portfolio theory stuff that we can look at in a bit. I'd love if you guys continue. If you've got more, or I can start bringing some of those up.
Yeah, I want to kind of talk about, because for a lot of people that are looking maybe for the first time, particularly with investing in Rocket Dollar, or maybe they haven't even invested yet with Rocket Dollar, but they're thinking about, hey, I need to diversify, I need to get away, and I need to find some more yield. I'm looking at alternative investments. But let's focus in on a little bit around what someone should look for in a private debt fund in particular. And the reason I want to talk about that is because obviously we have some expertise there. But number two, some of these things will apply across the board for any kind of private investment. But if you're thinking about lowering risk and non-correlation, but there's some other things that are probably some things that you ought to consider when you're looking for investing into a fund, or what to look for in a real estate debt fund. So I'm going to kind of toss that to Chris, because he has this 25 years of work in different institutional funds and really knows the ins and outs of what can make a fund more risky, particularly operationally. And I think that's one thing that a lot of people don't realize, is there's an operational risk there. And I'll let Chris talk about what that is for investing in private investments.
Yeah, I mean, there's the risk that people take when you go into alternatives. You are investing with a team who is running a private fund. And one of the projects I had for a multi-billion-dollar organization was to create an entire due diligence process around operations to effectively assess what risks are you really taking operationally when looking at alternative investments, because it's often a risk you're not compensated for. So in the investment world, you want to understand what risks you're taking, and you want to make sure that you're compensated, and the return you're getting from that investment matches those risks. And operational is usually not one you're paid for. And what I'm really getting at there is to make sure that they have process and procedure in place around safety of controls of capital, making sure that you don't have one guy and some other family member or something else like that, in control of every single movement of capital. You want to make sure you've got interested third parties involved in that process, and there's some type of oversight for that fund. And that may be, depending on the size and the nature of what you're working on, could be third party, for us, like a fund administrator, which is dealing with middle and back office, structures and oversight, auditors, so that you at least know throughout the year you're going to have to be reporting and having that monitored. And then having a clear dual control, even amongst partners, of who can authorize what. With regards to our fund, I can go in and enter anything I need to move money-wise, whether it's sending money out for a loan or paying management fees or anything else. But every single one of those steps has to be authorized by a second person, which is our CFO. They can go in and they can make sure that I'm moving money the right way, and they can verify that I'm doing correct things within mandate of what we're supposed to do for the fund. And then also one of the things that I think is very important, I've always required throughout my entire career, is transparency. Really working with a fund and a group that understands what they can tell you, so they're not giving away any kind of secret sauce. But it's also important aspects that will help that investor better understand how it's going to fit what they've already created as a portfolio. It would be almost impossible for an investor to assess, what is this fund really doing? I've told you what I've done, but I haven't really shown you, and you don't have a look through the window. And so you really should try to get that transparency that you need to help make an educated decision if that's a fund for you. It also is one of those things that helps build trust. If I'm willing to basically show you and talk to you about anything we're doing, trust is a very important piece. There's got to be a transfer of information over time, and so that trust can be built. And it also will highlight one of the biggest things that a lot of alternative investment platforms do is some level of style drift. That's something of risk. That's hedge funds, related venture, real estate, anything. I can tell you one day I'm doing something, and then all of a sudden, if you don't pay attention, a couple of years later, I'm doing something totally different, or a material piece of my portfolio could have changed. So there again, that can be alleviated through that transparency. I think those are some of your biggest factors of that operational process and procedure, lack of style drift, the transparency. Those are all key operational factors. And then obviously the ones that most people focus on, which is very, very important, is understanding and background of who are the managers. These are the people that are managing and pulling the trigger and putting those investments together. I think everyone pretty much goes after that. But make sure you're getting that background check. Make sure you're going in and really understanding that these people do have the knowledge, not only to understand the real estate, but to run a fund. A fund is not easy to run. There's lots of rules and regulations and aspects that need to be understood, because often not, I don't know the exact percentage now, but most fund failures, it used to be upwards of 66% of alternative investment fund failures didn't occur due to a problem with the investments. It occurred on the operational side. It occurred because someone didn't know what they were doing. Someone tripped over a regulation. There was some type of accounting mismanagement, something of that nature. And sometimes that's hard to be able to understand, but it's something that that's the kind of transparency in what you need to achieve, operationally, so that you can, further mitigate your risk and make sure you're not taking on greater risk than you need to.
Got it. Thanks so much, Chris. And so anyone in the audience, do you really have any questions for Chris and Brock on real estate debt? I'd love if you'd throw them out right now. I have some slides that really kind of go over a little bit of the portfolio theory stuff that you might hear about and how alts really fit into that. We can get in those slides in a bit, but if you do have a question, feel free to throw that into the chat or Q&A. And anything else before I get started, Brock and Chris, that you want to cover quickly?
Yeah, while we're waiting for some questions, which I look forward to answering.
Awesome. Sure.
One of the other things is you want to make sure that you're really enjoying reading that PPM.
Yeah,
I say
make
that
sure
tongue in
read
cheek.
your docs. Yeah.
Yeah, read your docs. I know they're not the most exciting thing. One of the other key things to look for in there is what kind of fees are you looking at. So the fees, super important. There's a lot of difference. Chris and I, before we put this fund together, and as we were putting together our docs, we looked at a lot of different debt funds out there, and we were actually pretty shocked at some of the fee structure out there, and what was being put in there and what was being charged to investors. We decided we wanted to be very investor friendly up front. We charge a 1.5% flat fee. We don't charge any kind of incentive fee. Chris can maybe mention why, but that is one thing we really encourage you to look deeply at when you look at these different debt funds, is look at the fees. Look at how your managers are either incented or compensated, because it will make a difference.
Yeah, it makes a difference to your return, for sure. The other thing is it's kind of weird to think about it this way. As an investor, you also want to make sure that the fees are commensurate with where these guys, in understanding their goal for the fund and the capacity of the fund, saying, okay, well, if they're going to go run, $100 million fund, does the fee structure that I'm paying as an investor, are they going to be able to run a business? Because if they can't run an effective business and they just came in cheap, well, then it ends up failing and having other stresses that causes a failure of the manager. So then you're looking at, that's going to create obvious stress for the fund. So, there's two sides to that coin. Is one, you want to make sure they're fees that are commensurate with the management that's being offered, but also, you got to remember you're assessing and working with a group of people that are running a business as well.
So we've got a couple questions now, Chris.
Yeah.
So let me dive into that.
Sure.
So Anna Simpson asks, what are the returns to investors and what's the holding period? And I think that's very similar to Michael K's question about what's the expected liquidity of the investments made into the fund. So first, we target 8.5 to 9.5% net returns. That means net means after both fund expenses and the manager fee to our investors. Right now, we're running at just above 9% for, if you look at it from a yearly standpoint, although we just have 9 months under us. So, you know, we're coming in right on that target. We're super happy about that, especially during this difficult coronavirus time. The holding period we look for is a 1-year lockup. Now, this is another thing to watch out for too. I mean, obviously debt funds, and I'll let Chris talk about this a little bit too, around misalignment of liquidity. It's a huge issue for alternatives, something Chris loves to talk about. But you know, one of the things is like we need to sort of align investor dollars with the length of term for our loans. We make 1-year loans, although most of them tend to be around 9 months. So when we make a 1-year lockup, and then we say, hey, you can then come back and say, I want my money back, or I want a certain amount of money back. Then we say, okay, well, we'll do best efforts of around 90 days to get that out. So you got to look for that in the docs as well, as where's that liquidity and what are they promising? Is that different? Is that a different alignment than what the actual investment is, Chris?
Yeah, no, I mean, that's one of the biggest problems in '08 that hit the hedge fund world was a mismatch of assets and liabilities, where people, and simply put, I'm investing in something that's long term. I'll give you some absolute horrible examples. People were locking into 3-year private investments, yet offering quarterly liquidity. And when there was a run on the bank after initial holding periods and locks were out of the way, all of a sudden no one got their money. And what people experienced throughout '09 was what they call a gate, where funds basically came crashing down and said, well, I'm not going to return anybody's money. I'm going to gate the fund because I've mismanaged the asset and liability. So that is another factor you need to consider when looking at a fund, is like, okay, well, if now our portfolio, all our loans, we target 3 to 12 months. So we basically figured a 1-year lock. There's 2 aspects to that. Is one, being a relatively new fund, we need some solid legs under us to give us time to deploy money and work with investors and build the portfolio. But we also realize that it's after that 1-year lock, it's a quarterly liquidity with a notice period. So we feel that obviously all loans are not coming off at the same time. They're usually spread out over the year. And in our liquidity analysis, we basically assessed that quarterly would be the best match after a 1-year lock, with the type of liabilities or assets we're going to be taking into play, which are going to range from 3 to 12 months.
There's a couple more questions here.
Yep.
So we'll take what geographies do you specialize in? We do nationwide. We don't, instead of restricting and saying, oh, we only do the Northwest where Chris and I sit, we really look nationwide, and we'll accept inquiries, or we'll accept loan applications nationwide. And we look at also secondary and tertiary markets. Now, the reason we do that, both Chris and I come from smaller towns. We're very comfortable with understanding the dynamics and the economics of these kind of towns. That doesn't mean we'll do the loan. What we look for is, what are the economics of that particular place where the loan is being applied for? Do they have a growing economy? Do they have a stable economy? Do we have broad-based employment? In other words, their employment is not based on a single large employer that if they go out of business, the town dies. So these are some of the things we look at. I won't go into a lot of depth about that, but we don't necessarily specialize in a particular geography other than nationwide in the United States. You do need to be an accredited investor. Unfortunately, Rocket Dollar, or that you're investing through via Rocket Dollar, doesn't make any difference there. That is something that's a SEC requirement. Minimum investment is $100,000, but for you guys on the call here or on this, if you're listening to this, we will, because you're part of Rocket Dollar, allow you to go down to $50,000. So if you just let us know when you apply through Rocket Dollar that, hey, you're part of the Rocket Dollar deal, we will accept starting out at $50,000, but normally it's $100,000. I think we kind of answered pulling funds back to my retirement account. I think, Chris, you answered that pretty well. We'll do, once the year is up, we'll do quarterly redemptions. Now, one other thing to be clear about too is that when you invest, you have a choice of either getting the interest payment to you every month. So that's kind of the fixed income part of it. So if you're nearing retirement, or this is going to be money that you're relying on to live on, we will send you an interest payment every month back to your retirement account. Or if you're not retired or through a retirement account, it just goes right back to your bank account. Or you can choose to compound that. And then whatever you choose in the beginning, you're not locked into that. You can always make a choice. And then I think it takes about 60 days for that to flip over. So if you choose to compound at the beginning, and then 6 months later, like, hey, you know what, I need this money to live on, then you can make that change in choice.
Yeah, the question there, we'll get you, it'll be K1 that's run by our fund administrator and our auditor. Auditor's also working and doing our tax. One of the things that we negotiated with those two entities was to be what they call off cycle. Two things that achieves is, one, it's a much lower expense to work with them in completing accounting. And by being off cycle, we're going to hopefully be able to get all our K1s out to investors, before final tax period of, April 15th. So that's actually already in process. I mean, we already have full approved financials transferred a few days ago, actually, in the hands of our auditor, and they're already working on that right now. So we're estimating that, by the end of February, beginning of March, we should have full K1s done. So that's something that, being an investor that usually doesn't finish his personal taxes until October of all the private deals I work in, I'm well aware of trying to be timely and ensure that we can get proper documents out to investors.
So there was another question here about investing in specific deals or loans. No, you're not investing in specific deals. That's what you're, in some sense, paying us as managers, professional managers. My 25 plus years of finance and underwriting and auditing, in leading the underwriting team to look at those loans. You're really not having to pick and choose among those loans. You basically look at our background, our fund, and say, hey, that's what I want. And then you invest money in the fund, and look at your statements every month and be happy about the returns. You don't need to look at each specific deal or try to consider this one versus that one. The other nice thing about that is your money in the fund is then spread among multiple loans. And again, this is one reason why we like this micro loan space, is because you're spread among 10, 12, 13, and as we grow, that's just going to grow 20, 40 loans. And so that reduces your risk versus being invested in any specific loan where if something goes wrong with that, then you're kind of hosed.
Different regions, different economies.
Yeah.
That's right. That's right. You're broadly invested across a lot of these different places.
Yeah, I mean, the actual structural accounting behind it is there's a rebalance of the portfolio. So if new loans are brought in, everyone's participating and achieving continued diversification as new loans are brought into the portfolio. And that's actually rerun every single month, because it's one of the goals that I want to be able to create for investors, is really having a growing pool of diversification across multiple loans. Because if one of them goes wrong, then I want that to be de minimis. I mean, I want it to be it's bound to happen for one reason or another. I mean, no one goes through an investment world, with everything being perfect, regardless of the amount of effort you put in. But through that diversification of being in, rebalancing every single month for every investor on a pro rata basis is creating, an ever growing diversification.
As Buffett used to say, if I may kind of twist his words a little bit, we're doing everything we can to not lose the effing money.
Yeah.
I mean, really, that's Chris and I have our significant amount of our net worth and capital in this. And we're at a time in our life that we want to make sure that we are doing everything possible to mitigate risk in what we invest in the loans that we make. All right. Another question was, based on the economy of the town, what makes a tertiary market? Honestly, this is a very subjective thing about what's a secondary or tertiary market. I guess in my mind, a tertiary market is some market that's got maybe 100 to in like say the county area, or some city that's sitting between a couple of counties. I'm looking for 100, 200, 300,000 people, but I'm still looking for that broad employment factors. I'm looking for is that part of a major transport hub? Let me give you an example. I'm looking at an industrial place right now that we're looking at a 55% LTV on, that sits in sort of that the triangality of Tulsa, I think it's Oklahoma City, and I can't remember the other city, but I mean it's a little town of like 10,000 people, but it doesn't matter because it's right off the highway on a major thoroughfare. So particularly for an industrial property, that makes sense because your trucks can get in and out. They're not going to be they're not going to have a lot of traffic issues. It's right off the highway, right off an exit. There's a number of reasons we look at that and go, well, yeah, that's a tertiary market, but it totally makes sense from an economics and property standpoint. Location. It makes sense for the property. So hopefully that answers your question on there. And then, Chris, do you want to take that next question from Anna?
We don't do a return on a note to the investors. You become a member, an interest member in the fund. So
yeah, so we had a few note presentations in the last week. So we have a lot of investors that were talking about that, and they go, "Oh, I don't know if I want to be doing this individual note or not. If it's right for some people, a fund is better for some other type of investment."
Yeah, it's very particular. I think at the end of the day, I mean, it's about that the risk profiles of how they're structuring that note and what you have exposure to, and how they're utilizing, and the payment given the risk you're going to be taking. It's something you do need to be worried about. I know some people out there that go out and pay 8 to 9%, but they're taking risk at 15, 16%. That's a pretty big spread. So just trying to get that transparency and understand of, well, what's the note you're being paid on and what kind of risk are they exposing you to as an investor? It's something that, it's one of the reasons we didn't go that route. I understand the other aspect of being a note to a note structure or a table finance aspect is, okay, I can get you 1099. I mean, so yeah, that's another particular advantage of that. But there again, you do need to understand the underlying investment and the structure if that meets what you need. Whereas in our fund structure, we're passing along the return minus management fee. That's it. I mean, so you're getting as much as we can possibly get you on a net basis. There's no interest rate spread we take.
All right, and any more questions in the audience? I had some slides to go through on some portfolios. I know we've had some great questions and engagement. I didn't want to stuff anyone and make sure they didn't get their question answered. Brock and Chris, you want me to just roll through some of that? I don't know if I'll go through all of it because we only got a few minutes left. I'll just bring up a few things just about a portfolio because I thought that'd be really helpful as we're talking about real estate and debt as a bond replacement. I won't go through the whole thing here because I know we only got a few minutes left. Share screen. All right, can you see my slides here?
Yeah.
Okay, great. I'm gonna skip the beginning, but something I wanted to say quickly. Hey, this is not investment advice. I'm gonna just talk a little bit about portfolio theory, but this is something to talk to an advisor about and talk to a CPA about. And we always kind of have to say, one thing that is frustrating though, is if you run in stocks and bonds advisors, a lot of times they're just not going to have expertise in alts. So just know that is a really frustrating part. And sometimes in alts, you have to talk to your advisor and then you have to think for yourself as well, really come to that decision. All right, so what is modern portfolio theory? Brock and Chris were talking a little bit about replacing bonds, replacing income. Basically means you're making a theory, how much risk you're going to take in a constructive portfolio to maximize returns on a given level of risk. So the more aggressive you get, you're probably taking some more risks. If you pull things back a little bit, you might have to accept, hey, the return might be lower. You might miss out on some crazy high weeks in the market or investments. However, you're going to feel calmer. You're going to be calmer when things go wrong. This is what people are paying a lot of financial advisors for, to rebalance their portfolios and look at them. The S&P 500, everyone knows what it is. What I just want to let people know is everyone's trying to beat the S&P all the time. However, just know the S&P is a moderately aggressive strategy. It's the most aggressive stocks is some of the biggest stocks. A lot of them are still moving. And a lot of people always try and benchmark every single investment against the S&P. When you know that when you're trying to compare things, just know you're comparing things to a moderately aggressive strategy. So if you're looking at a moderately aggressive investment, maybe that makes sense. If you're looking at something lower risk, maybe the S&P is a terrible benchmark. Maybe you're looking at something insanely high level risky. The S&P is, again, not a great benchmark for that. And just looking at this modern portfolio theory, what do advisors, why are they doing this? Generally, a younger investor, they can take greater risks when they're younger, they can lose some capital, take some hits. An older investor, especially near retirement, like you look at older investors in 2008, and then even some just in March of 2020, they're trying to be as defensive as possible. They're pulling back from maybe being so exposed to certain higher risk parts of the market, and sometimes even the S&P as well.
I think one of this is great stuff, Brendan.
Yeah.
Here and really important to think about, particularly with these older investor, as you get up in your closer to retirement or where you're going to need that money. One of the things to realize is that the average of the S&P 500 is not you. You actually belong to anywhere, and it's really a gamble in some sense of where if you look at any particular, let's say 10 or 15 year period, I think it's a 15-year period I'm remembering, of the S&P 500, then you could either have made up to around 19% returns, which is wonderful. You think, oh, that'd be great if I could make 19% returns by investing in the S&P 500. And there was a particular 15-year period where that was true if you timed that market right. The problem is that's not you. Then there's another period of 15 years where you actually lost money over that 15 years. So the key there is to realize as you get closer and you're maybe 10 or 15 years out, that timing of the market where you could end up and need your money becomes incredibly important, as we saw in 2008, where we had a lot of people who were ready to retire and then needed to say, well, now I got to keep working for years.
Yeah. And that's that time that people are looking when to pull out. Some people pulled out in March of 2020, and then now they're afraid of when to get back in. It's that thing, a younger investor, they could take some risks on that. They could throw in kind of aggressively at a random time, where someone in 55, 60, 70, 75, they have to be extremely careful what type of assets they're considering and when they pull in and out of the market. So this is the very standard portfolio that you've always seen. And this is something, we said, hey, is this dead or not? This is what people are usually looking at when they look at the general stocks and bonds portfolio. You've got conservative, just a lot more bonds in the portfolio. Sorry, they're all in blue. I have some color blindness going on, but moderate portfolio, a bit more stocks, a bit more balance in there. And then an aggressive portfolio that has a lot more stocks. You'll see a lot more S&P in there. And that was really, what Brock and Chris were talking about, is that was like the only slider so many advisors have been using for a really long time. Do we put bonds up or do we put them down? And as bonds got into this risk level, a lot of investors just step back and go, what am I doing? If this is the only lever I've got, I need more tools in my toolbox.
Yep.
Okay, so just a real standard answer from someone at Invesco. Everyone asks, how much should I have in alternatives? This is a constant answer. I would say real estate people generally tend to be higher in alts when they know real estate. But what does this investor say? There's no correct answer how much to invest in alternatives. From this guy at Invesco, his experience that between 5 to 30% of their portfolios in alternatives. Many of the investment firms that he works with, they're in the stocks and bond side because they're at Invesco. A recommended allocation of 10% and 20% in alts. And this matters, to compare to your risk tolerance and your comfort using alternatives. This guy, Walter, believes that, if the investor decides to allocate to alternatives, he should allocate a sufficient amount so that can have impact on the portfolio. If the allocation is too small, it's not really going to do much or maybe achieve the goals that you're trying to get by adding alternatives.
Brendan, let me add a little bit to this, if you don't mind.
Sure.
I think one of the things, I know particularly for myself is I've been in the real estate industry, of course, for all my career, but I will tell you from looking at alternatives and from the outside and talking with so many people is don't be driven by fear. You're looking at this going, oh man, all of a sudden I've got to put 10% of my portfolio on alternatives, man, I don't know if I can risk that. I don't feel comfortable yet. It doesn't mean that you can't start very small. I would encourage you, go pick out something, maybe on the low risk side, to get started with on an alternative, and put the minimum investment in there, put 50K in there and watch it for 6 months. You're going to learn an incredible amount by just investing that, maybe that minimum 50,000 into a particular fund. Doesn't have to be ours. Love it if it's ours, but you put it in there, you start getting statements, you start getting familiar with things. It's amazing what the difference is when you're actually know that your money is involved in something and how you start to pay attention to that. And then as you build comfort in understanding how a typical private investment works, what you can expect of that, then you can start to ratchet up to that where you need to be, which is that really 20 to 30%, or even more if you feel comfortable with it.
I've heard traditional stocks and bond advisors say as much as 40 now, and I think that has been progressing. And just so you know, when there's a lot of people work in stocks and bonds, they also charge in a certain way. So, Brock and Chris make, they make money off real estate, and they're going to always pump real estate. There's a lot of the stocks and bond industry that charges from their stocks and bonds. So the advisor is always going, put some in alts, but don't take it all away from me. There's always that fear from the advisor that all the money is going to go off their platform. So just know a lot of people have great advisors. Some people have not so great. It doesn't necessarily mean your advisor is bad if they don't like alts. However, just know they charge from a certain way. They have their interests, and you just kind of have to separate that and speak honestly with them, saying, hey, I want to put some in alts. I'm confident I want to have that conversation with them and see what makes sense in your current portfolio. So just looking at the portfolios of like an average American compared to the ultra rich. So this is like a big comparison that pops up a bunch. This was from 2020 when I pulled this up. There's a lot of ultra high net worth individuals, both in America and internationally, that put money into some function of property of investment. Is that directly in the property? Is that debt? Some type of real estate that they're going into, and they're putting their money into that asset. And a lot of investors, this is opening up now, but when you're not accredited, sometimes it's hard to get into these opportunities. You gotta network, you gotta talk to people, keep working up that asset level, keep looking for deals. If you're frustrated you can't find something, keep looking, keep networking, and you will find opportunities. But the rich are often not just in the S&P 500 and a few index funds. That might be part of their portfolio, but they spread that over many different types of assets and alternatives. Here is another old one, just because it's in the same pie chart. This is from 2012. So this kind of reflects, just looking a bit back, reflects, this one was more modern, from 2012. Hedge funds were popular at the time. Private equity, venture capital was just a small bit. Silicon Valley, people were trying to experiment there. You'll see real estate is down there, direct investment, municipals were a big talk back then. Just in that pie chart. So, you can think of your own portfolio in the pie chart and just think, hey, how do I take a slice of this, a small slice, diversify that? Once you get more comfortable, you can continue to bring that up to different levels. And just know some of these assets are higher risk, some are lower risk. You don't want to replace all your conservative investments like your bonds with super aggressive ones. You want to be looking for income replacements. For your more aggressive investments, you want to replace them with other aggressive investments. You don't want to get your portfolio way out of whack when you suddenly put an alternative in it in your risk level.
Yeah, one of the key aspects of alternatives, there's two primary goals you're looking for in alternatives. Is you're either looking for a return enhancement vehicle, so you're looking for a hedge fund or some other type of instrument that its primary focus is to really try to put up some bigger numbers. So you're probably going to be taking a little bit more risk within that type of instrument. The other aspect for alternatives is a diversification to your portfolio. You will find some alternatives that will do a cadre of both. But you really do need to identify, why am I adding that to my portfolio? Am I return enhancing, or am I diversifying?
Yeah.
And that'll help you fit what you think you need and what you're actually replacing in your existing portfolio.
Mm-hmm. And one last quick slide in the portfolio, what was happening during COVID here. For the ultra rich, that usually they're kind of thinking from a capital preservation standpoint. They're trying not to lose anything. They were slow to put their equity back in. That happened across a lot of different Americans of different wealth levels that might have missed out. Lower risk debt, looking very carefully at their debt portfolios. Where was their exposure in their debt and reevaluating that. Gold and defensive assets, and then also like international stocks. And there's a lot of stuff going on this slide, but I wanted people to think about just the top here. This is again from the guide in Invesco because they have a lot of experience in alts there. But these are often a couple goals that I hear people at Rocket Dollar saying. And the next slide, I'm going to boil it down even simpler. Inflation hedge, principal preservation, the ultra rich trying not to lose money, portfolio diversification to get to some different types of assets. Equity diversification is about the same thing, and fixed income diversification, not being invested all in the same bonds. So when I talk to people at Rocket Dollar, when they call me on the phone, this is usually the three things they're looking for. They're looking for yields or income, something to kind of replace their bonds in their portfolio, what we just talked about today. Some type of stable producing asset, something where they know what the expected return is right when they enter that. Real estate is often giving you that angle. Alpha investors. These investors are the ones looking to beat the S&P. They're looking for explosive returns. They want to kind of shield that in a retirement account. And usually this is a replacement or an add-on to their aggressive style stock picking. And
a better way to think about alpha, I mean, yeah. Alpha is a term that many professionals actually don't have right. Alpha is actually a basis and a derivative of the information ratio that's out there. You're basically looking at alpha. If you're looking for alpha on an equity based, yes, your benchmark or effective benchmark might be the Russell 2 or the S&P 500. I don't actually compare. If you're looking at a debt fund and you're an alpha investor and you want to capture excess return that has, well, the definition of alpha is that return has no correlation to anything. That is literally the definition of alpha. And so if you're looking for that enhanced return that has no or little correlation, you need to understand the asset class you're looking at. So one of the things that and it's difficult in real estate to find a consistent index to compare yourself to find and build a benchmark. But so if you are looking for excess return, define what that means to you in your portfolio. If I'm like, hey, I'm a high yield investor and I'm going to go make 5% and I have something that may have similar risk or lower risk, but it's going to give me 9%. Well, in your world, with a volatility adjustment, you might think that, wow, then my alpha on that investment compared to my benchmark really is, 3 to 4%. And so I just want to make sure that's apparent, because alpha is actually a pretty complex product. It's what everybody looks for. But being an ex-arbitrage trader for 8 years, it's something I spent most of my career really working to define and help people understand, because alpha is generated differently. And it's definitely something you're looking at. The basis of it is I am looking for excess return that has no or little correlation to whatever my chosen effective best fit benchmark is.
Yeah, and that's a great description, because the reason I put that specifically on this slide is because people talk about it and they don't often know what it means.
Yeah, it's a lot more complex than most people give it credit to.
Yeah, so I'll hear people talk about on the phone, and that's why I kind of added these slides. These are a lot of like simple things people throw out, or they hear advisors throw out, but they don't necessarily know what the background is. And the last thing here is just like a non-correlated asset. And that can mean a lot of things. Some investments could meet multiple of these, these things, these goals on this sheet, but it's something that really is not connected to public markets. So, Bitcoin has been pretty explosive recently, but people always said, oh, it's not correlated to the markets. It's like gold, it's defensive, it's whatever. But for most of the year, the last couple of years, it was following the S&P. It was following the ups and downs of the markets quite closely. And a lot of people get frustrated is that a lot of other assets have been pulled in to just follow the same swings of the S&P. And so they're in what they think is a non-correlated asset. People go into like a REIT, a traded REIT on a stock exchange, and all of a sudden they watch it move.
Yeah,
Just
glad you
like
brought up the
market.
REITs, the public
Yeah.
REITs.
Yeah, I mean, correlation is one of those things that there again gets pretty complex. And one of the ways to analyze correlation, a lot of people like to throw, here's my historical correlation over the last, 10 years, depending on what kind of, track record they have and the time frame. But you really need to look and break down, how did it actually do in a stress period? So finding people who can look and say, hey, this is how my asset was counter-cyclical, as another way of saying non-correlated, in times of stress. So, like in '08, everyone all of a sudden loved managed futures and global macro and a variety of other things, because those are naturally counter-cyclical strategies that, or your, the long vol players, they were the other ones that were very popular. And so, understanding how they perform in a shorter window around a stress period is really that true offset to your portfolio when you're looking at correlation. So you can't just look at, hey, here's what it was over the last 10 years. It's like, okay, what was it within this, 1 year period around a stress period? It's a good added way to look at how your asset will perform from a correlation standpoint.
Great. All right. Thank you, Chris. This again, the same from this guy in the Invesco blog. And what I really thought this was interesting, just look at the annualized return and the maximum decline. And I'm sorry, I don't have the year for this, but what I want you to just look at is the annualized return. This is like, trading that risk for the potential downside risk. Some things have decent returns, but they have a lot of downside risk. So you just have to really look at that when you're looking at your portfolio and different goals. An asset can be doing just fine for you, but you have to know where you're exposed. And sometimes, you just don't want to lose your money. Not losing a ton of money can keep you just ahead in your retirement portfolio or building wealth over the long term. And I'll just go real quickly over, finish up here after this. This is where I hear people calling us up on the phone. They're looking for those goals we just talked about. What assets are they actually talking about going into? Yield investors, real estate debt, like we're talking about here in the webinar. Rent-ready real estate, stuff that's prepared, not like a risky construction or something in a totally unproven area. We have some farm investors that have come in, performing notes, notes that are protected and, they're already income producing in some way. Mineral rights, we just did an energy webinar. This is basically paying rent on an energy property that's already spitting oil out. You have none of the risk of oil exploration, but you're getting that rent. So we like our mineral rights people. We're like, we're not energy, we're real estate. Everyone wants to keep saying they're real estate. What they're really trying to say is we have some of the same similarities in risk level or types of the asset class. So there's some mineral right properties that are super safe. There is some energy exploration that is insanely risky. And we just talked about that in a few webinars. So I thought that was interesting to add. And again, the alpha investors, alpha with asterisks here, you get hedge funds trying to beat the market, trying to do creative strategies, private placements, private equity, trying to go after private businesses. People at Rocket Dollar will go into a LP investment. Startups, venture capital, and crowdfunding. Venture capital is definitely the most mature of those that I mentioned. Startups and crowdfunding is much more of the, rebellious, going into a small investment, taking a very high flying risk. People usually do much, much, much smaller dollar levels than that compared to venture capital. We have aggressive crypto traders. They're just around. It's really popular right now. It's been especially aggressive right now. You just have to know that's replacing the very most aggressive part of your stocks. That should not be an entire part of your portfolio. Very aggressive real estate ventures trying to do some total flyers, new construction and unproven asset. Energy exploration, missed my bullet point there, for a type of, someone who's trying to beat something going on in their other assets. I didn't have to, if you have anything to add, Chris and Brock, on the defensive assets, but, low risk of eviction real estate. I had, something like a mobile home parks, self-storage, assets that are really hard to, lose your rental income that are coming out of that. Sometimes people will choose international investments because those move differently to the United States markets. However, we're in a very global economy. So sometimes they're not always as defensive as people think.
Yeah, that correlation is getting higher in stress periods, global stress periods. International investments are not providing, they're different return profiles for sure. And there's a lot more availability on the alternative side. You can now go from developed international to emerging market to now even frontier, depending on what type of risk you want to expose yourself on the international. And, the risk profiles and the returns are quite different. So.
Yeah, and that's why I put it up here, because this has been talked about as a defensive asset for a long time. When I first started as a financial advisor, international investments were constantly, thought of as a defensive asset. However, when we hit a pandemic, when Brexit happens, when these just like international events, we have very connected economies. And so one economy, when China goes down, can affect all of Asia. It can affect India, America business going to India, investment going in there. So all of these markets are more interconnected. So some of our investors will go for a specific asset. Instead of going to the wide market, they'll go actually to an international asset more directly.
I would certainly place types of real estate debt in here as well. I say types because there are certain real estate debt funds that do take a higher risk, or ones that are funding, let's say, more of the fix and flip or construction. Those are higher risk, but we've situated our own fund, and I'm sure there's other debt funds out there, similar real estate debt funds, that are particularly situated for that defensive asset allocation.
Yeah. Crypto stable coins, I just put there up because a lot of people will keep asking about them. One thing to make sure with that, maybe they're trying to peg to a currency or to precious metal, you have to make sure that coin is reputable and that the money is actually there. So we did a gold webinar a few months ago. There's all these gold stable coins. However, when they audit the reserves of these companies helping officiate that stable coin, the assets haven't always been there. So crypto is definitely a bit more wild west. And anything even in crypto considered defensive or stable, you really have to check who you're dealing with, what's going on with the asset, is it being audited or protected.
Just like any investment in precious metals, you have to understand what they call allocated versus unallocated. In the early days of ETFs, the gold ETFs, they would often market that they're fully allocated, which basically means in the central vault, usually it was JP Morgan's central vault in Midtown, New York, you had an allocated gold to your ETF. So you were truly supported by the asset. And then there's just the boom of the amount of just sheer dollars flowing into ETFs, which is going to be the same issue of any type of other derivative structure around precious metals. There's just not enough precious metals that can be allocated to meet the demand for all the currencies, dollars, euros, anything that's flowing into those. So it is something to, you would need to have a catastrophic problem to realize, oh my God, I'm invested in an ETF that doesn't have 100% allocated gold. But it is something to think about. I mean, you will be in an asset that you're basically marked through a derivative security to the asset, but you are not supported by the physical allocated metal or asset.
Yeah, so. And I think that's something, especially to check on bigger investments. When you're closer to an investment team, you can really kind of check on exactly what asset your account is connected to. When you get to something more like public markets and funds, like Vanguard has an incredible reputation. However, when we go look at all funds across every single company, you got to make sure there's a lot of demand for these assets now, because it's continuing to see markets rise. You have to make sure that your asset is backed. Is it connected to a real asset? Have they audited it? Have they, how is that done under stress? Have they ever checked at what's happened when a ton of investors pull their capital out? And, I've seen some companies, struggle with that or do well with that as well. Last thing, because, coming from a family that worked at McDonald's Corporation, franchises, we have a franchise partner now that we're bringing on. Something that was normally very stable, but the Black Swan event of COVID, really just something like a restaurant, a McDonald's or a Burger King franchise, just anything could happen in the United States, that'd still be producing income. They have a drive-through now, so there's some of them are still okay, but restaurants, doing much harder. Something like a haircut franchise that people franchise out different barber shops. Something very stable now suddenly not so stable as people skip haircuts, stay inside. But something definitely, it's still an asset to consider that's maybe not as connected to the public markets because you're much more connected to a small business in an area that produces income like that.
Correct.
And so just finishing up here, thank you for everyone who stayed along. I hope anyone who's tuning into the recording as well. We're going to blast this out, both parts and the first and second part, so we can really talk about these different assets. You can get $50 off sign up at Rocket Dollar with Kirkland, and we start at $360 and $15 a month. That'll knock $50 off the sign up fee. So, and any questions still around? Thank you for anyone who's sticking with us. All right, we'll wait just a minute or two for questions, then we'll probably close up. Thank you, everyone, that stuck around for the entire webinar.
No, thank you.
I know we really we usually clock out at an hour for each one, but when we have a lot of good questions, a few times we've gone over. Okay, I'm not seeing anything, so since let everyone get back to their day, appreciate everyone sticking by. Chris and Brock, thank you so much for stopping by. And
thanks so much, Brandon. We really appreciate it.
Yeah, really appreciate the time. Thank you, everybody.
All right, thank you. Bye-bye.
Cheers.